The Federal Reserve just lowered interest rates in the most aggressive manner since a financial crisis. But what does that even mean? What does it mean for the Federal Reserve to lower interest rates? And why should you care? Well, in this video, I'm going to tell you exactly why the Federal Reserve's moving of interest rates is going to impact your life. I'm going to first talk about what it even means for the Fed to do this, and then also how it will actually trickle down into your personal finances. Most notably, you're going to see a change in the interest rates charged at your savings accounts. You're going to get paid less interest on most savings accounts out there. And now, why is that? Why does everything move in tandem? Well, stick around, watch this video, and I'll tell you exactly why. So my name is Kevin Conway. I make personal finance videos like this one all the time. So if you like that sort of thing, be sure to subscribe to the channel and give a like to this video because you're not going to want to miss the personal finance changes that are going to occur in the next 24 months. So believe me, you're going to want to see them. So give a like, subscribe. Now let's jump right into it. Ordinarily, explaining how the Federal Reserve works may seem to be pretty boring, but these are not ordinary times. And believe me, once you know how the Federal Reserve affects all aspects of the economy, it'll make a lot more sense why you're going to see changes in your personal financial life. So first off, what is the Federal Reserve? Well, the Federal Reserve is the central bank of the United States. It is essentially the bank's bank, the place where banks can actually go and borrow from. The Federal Reserve also has broad authority to regulate banks as well, so they can actually tell banks how much they need to hold in reserves, and they could tell them how they need to operate. Now, why the Federal Reserve? Why is that the market mover? Well, the United States economy is currently the largest in the entire world, and so by virtue of being the central bank of the United States, the Federal Reserve has a massive impact on the way global financial markets operate. So you may be asking yourself, why would a bank need to borrow money? I thought banks are the ones that actually lend out money. Well, that's exactly why, because banks are required to have certain amounts of cash reserves at their banks, and of course, banks are in it to make a profit. So they want to lend out as much as possible. Whenever you get a mortgage or you just borrow money from your bank in any manner, the bank will lend that cash out, but it can't lend out all of its cash. And so in order to meet those reserve requirements, sometimes on a short-term basis, your bank may need to borrow from other banks or the Fed in order to keep those requirements satisfied. So how much does it cost to borrow? Well, it's not exactly like you borrowing money. No. Banks get a special interest rate that they can access in order to borrow money. This is called the federal funds rate, and it's a guidance put out by the Federal Reserve. It is incredibly important, and it determines how much banks will typically lend to one another for these overnight loans. Now, to be technical, the lending actually occurs between banks, and most of the time not between the bank and the Federal Reserve, but the Federal Reserve has a huge impact. This is because the federal funds rate is the starting target rate that all banks are going to start with in order to negotiate with one another to lend money to one another on an overnight basis. Now, some banks may be more risky than other banks, so the lending rate that that bank is going to incur is going to be slightly higher than what another bank will incur, but the average of all of these banks lending to one another on an overnight basis is known as the effective federal funds rate. Now, like I said, the federal funds rate is not an actual required rate that banks must lend to one another, but there is something that the Fed does in order to get other banks to lend to one another at around that rate, and that's by offering these banks the federal funds discount window or discount rate that they're able to access from the Fed directly as opposed to other banks, and that typically is only slightly higher than the effective federal funds rate. In other words, it's a ceiling in which the banks can borrow from in order to meet their overnight obligations. Now, this may all seem a little bit too confusing, but here is the key detail. Take this away if nothing else. In order to have cash reserves, banks need to pay their customers money in order to have savings accounts and CDs and other forms of capital at their banks. But because they can always borrow funds from each other at the federal funds rate, they don't like to pay much above that rate for other funding sources like customer accounts, like savings accounts. And so when the Federal Reserve lowers interest rates and therefore lowers the cost of capital for banks to borrow from other banks or the Fed itself, it of course is going to respond in a commensurate way by lowering the amount of money that they have to pay customers in order to get cash from them. In other words, when the Fed lowers interest rates, banks lower their interest rates they pay to their customers. Conversely, when the Fed increases interest rates, banks are incentivized to increase the amount of interest they pay on the cheaper form of capital, that is, the savings accounts out there, because that is going to be cheaper than borrowing from other banks or the Fed. And so they're able to pay more and more interest on those accounts than they would otherwise. Now, this is not mandated by law, and it's not always the case that it happens. Of course, banks like Chase and Bank of America, Citi, Wells Fargo, those brick and mortar banks that are highly convenient for most people to access, can get away with paying basically nothing on their savings accounts because they are trading convenience to the customer for interest that they otherwise would have paid to the customer. So basically, if banks can get cheaper capital elsewhere, they will, and you are the cheaper capital. So every time you ask yourself, why did so-and-so lower their interest rate, whether that's SoFi, Wealthfront, Ally, Marcus by Goldman Sachs, or any bank out there, just remember this calculus. And you can see this almost directly with these online bank accounts like SoFi or Wealthfront, which put out emails specifying that the Federal Reserve's move in interest rates has caused them to move their own interest rates almost identically. For example, this last time when the Federal Reserve cut interest rates by 50 basis points or 0.5%, SoFi cut their interest rate by 50 basis points or 0.5% as well. So expect with the latest Federal Reserve interest rate cut to see all bank accounts, online bank accounts, and brick and mortar cut their interest rates by some factor. I guarantee it'll happen to 99% of the banks out there. So you may be asking, should I move my account at so-and-so to another bank account which has a higher interest rate? I would say in most cases, if you have an online savings account, you should not switch online savings accounts. It's too much of a hassle, and all those online savings accounts are going to move in tandem with one another depending on what the Fed does. If you have a brick and mortar bank account, you're always going to be getting less interest than you would in online savings accounts for the obvious reason that they can get away with it. They are paying for the infrastructure, the physical infrastructure, for you to walk in and easily access your money. Therefore, they can get away with paying you less. Online bank accounts are by and large always going to pay you way more interest than brick and mortar bank accounts. So I would stick with your online bank account if it has an interest rate which is favorable as compared to other online bank accounts. Great online bank accounts include SoFi, Wealthfront, Marcus, Discover, Amex, and a lot of other accounts. I have videos on them if you want to check those ones out, but by and large, those are all going to move roughly in tandem with one another. So then it just boils down to convenience and preference, whether or not you like that particular bank's user interface, accessibility via ATMs, or any other manner of usability of their platform. That is going to be the differentiating factor for most people when they're deciding what bank accounts to have and whether or not they should move their money between bank accounts when the Federal Reserve does a large interest rate cut like this one. So keep this in mind every time the Fed moves up or down in interest rates. Of course, you always want to be looking for the best interest rate, but if you're bargaining between 5 or 10 basis points between your current bank account and the highest bank account out there, I honestly wouldn't move your money. I wouldn't go into the hassle of trying to move your money into that bank account. It's going to be too much of a pain. I would focus a lot more on what to do when the Fed is raising or lowering interest rates, because chances are if the Fed is doing that, they're doing it for a reason. Things are changing in the economy. Things may be coming on in the future that you need to prepare for, whether it's a recession or boom times. You never know what's going to happen, but the Fed will give you an indication depending on whether they raise or lower interest rates. And always remember, have your money sitting at an FDIC insured account, whether it's brick and mortar or online. I'd highly prefer online bank accounts because they will pay you more interest, but just make sure that it's FDIC insured. This means that the federal government will insure your deposits up to a certain amount, $250,000 most of the time, of deposits in that bank in the event that bank goes bust for whatever reason. What do you guys think? Let me know in the comments below. Let me know what bank account you have and whether or not you're planning on moving it. Be sure to give a like to this video if it helped you out in any way, and subscribe to the channel if you want to see more videos like this. I'll see you next time. Thanks.